You know, there may be some cash flying off corporate balance sheets, Adam, and that could, in fact, be the next catalyst to drive this market higher. But if you believe the New York Federal Reserve, this is going to be the headline. Listen to this one, everyone. Unemployment at 6% by 2013. That's the prediction from a new piece of research from the largest Federal Reserve bank, and it's begging the question, if this very optimistic forecast actually comes true, what's it mean for the market? We're joined right now by Larry McDonald, Senior Director of Credit Sales and Trading at Newedge. Also joining us, Charles Lieberman, Chief Investment Officer at Advisors Capital Management. And our guest host for today, Tom McClellan, editor of the family-run McClellan Market Report. All right, welcome to all you guys. Charles, is this even possible? I mean, is the New York Fed realistic to think that we could be looking at 6% unemployment in the near future?
Well, I think it's not fundamentally driven. It's driven by a little technical analysis, looking at the rate at which people enter the labor market or enter the pool of unemployed and the rate at which they exit. And they're not really making statements about the economy, which is, of course, necessary to really have a sense of how strongly people will be hired. That's the real driving force here.
Okay, so which is it? I mean, do you believe this could happen by 2013 or not?
I think it would require a much, much stronger economic growth pace than we've seen. I don't think it's very likely, but I do think the pace of economic growth is going to pick up, so it's not as far off the wall as it appears.
Okay, hold that thought. Back over to Larry for a second. Larry, do you think we could be looking at 6% unemployment as a rate by 2013?
Well, you know, you still have a large supply of people that are unemployed, that have stopped looking for jobs, and as they come back, that'll put pressure on the unemployment number. So
sending it higher.
Yeah, and it's a long way to go. I do think, though, that the markets have made a beautiful run over the last couple of months, and it's starting to factor in a lot of good news, including words like this from the Fed today.
Okay.
So Larry, can unemployment go lower from here?
Well, for the rest of the year, you know, we'll probably grind lower. I mean, I think it's going to have a big impact on the election, and we've been adding jobs every single month, around 200,000 and above. So, you know, we've got a good shot for consistent job creation. Whether we get to 400,000 a month is a different story.
So our big question is, if, in fact, I want you guys to put on an imaginary think cap for a second. If, in fact, you saw unemployment continue to move lower, I'm not saying necessarily 6% by 2013, but continue in this direction in which it's moving lower, what will that mean for the markets? Charles, first to you.
Well, the most important thing is corporate profits are going to do extremely well, much better than people anticipate. It also means the Fed is not going to be able to keep to its alleged promise that they're going to keep interest rates at zero out through the end of 2014. That's not going to happen. So it suggests very different prospects for the bond market versus the stock market. Stock market will have very strong momentum at its back. The bond market is going to have a very tough time.
And Larry, what's your trade under that scenario?
Well, I think you have to look at, you know, back in the 90s, all we had to really look at was U.S. unemployment, and you could really trade the market effectively. But now you have to look at China, you have to look at Europe. The Shanghai markets are down 6% in March. The S&P is up about 3%. So Chinese stocks are massively underperforming. Today, we saw the materials in the U.S., that sector, the materials sector, breaking down. And if you look at Europe, we got smacked last summer with a risk-off trade that was driven by problems in Europe, political problems. So you really have to look at China, Europe, and the U.S. employment situation to play the markets today.
Okay, Tom McClellan, you say there's no way in HELL that we're actually headed towards 6% unemployment. What's your prescription for how to make money in this market right now?
Well, first of all, whoever gets elected in November is going to get blamed for a huge spike in unemployment in 2013. How high? I don't like to deal in numbers. I like to deal in directions. And what I know is that unemployment tends to follow the inflation rate in terms of the direction. Inflation was bottoming about 2 years ago, and so the spike up that we've had in the inflation rate has yet to be echoed in a rise in the unemployment rate, which is coming in 2013.
But hang on, though, because inflation actually, given where we are on the curve, which is very low, inflation at this point might actually be a good thing. So you could see unemployment go down as inflation goes up, right?
Well, we're already seeing inflation in the real numbers if you factor out housing, which accounts for 41% of the CPI numbers. If you factor out the housing, which has been keeping the CPI low, we find that inflation is already up above 3% and has touched 4%. And so it's being hidden a lot by the way that the numbers are calculated.
Charles, you're shaking your head there. Do you disagree?
Yeah, the housing numbers, the rents have actually been rising at about roughly a 5% rate over the past year. Reflects the tightening of the apartment market, the rental market for housing. That's one of the reasons why we're as bullish as we are on housing prospects for the U.S. The level of construction is hopelessly depressed, especially when you put it relative to the rate of household formation. There's so much upside in the housing market, it's just absolutely unbelievable. And that's why if you look at the housing stocks, every single one of them, whether it's builders, suppliers, construction materials, growers of timber, furniture manufacturers, every single one of them is up dramatically.
Dramatically, but
weeks.
they were all at like $2 a share. So hey, you go to 4 and you're looking damn good, right?
Well, those are some of the more speculative ones. But even go to the ones like Home Depot or Lowe's. Look at some of the bigger home builders like an NVR, which is a company that was that made money even during the housing depression.
So Charles,
those things are up
you're
sharply.
saying housing is a place to be, yet you don't think that there's going to be a dramatic decrease in unemployment. How can housing really succeed if you don't have people back to work?
The trend is your friend. If you keep at 250,000 employment per month, payroll jobs per month, that's going to add a lot of buying power to the housing market. It'll create a lot of jobs. It'll create a lot of household formation. There are a lot of kids who graduated from school who couldn't find a job, went back to live with mom and dad. As soon as they find a job, they're in the housing market. We're going to see a dramatic pickup in housing activity.
Well, Tom McClellan, make the case, because I think you seem to think that unemployment is not necessarily going to fall. You think it's going higher. So make the case for why Chuck would be seeing the wrong side of the fence.
Unemployment has a few more months to fall this year, but it's going to be getting a lot worse in 2013. And what Charles needs to remember is that the prices of housing stocks tend to follow lumber prices by about a year. A year ago, we were seeing lumber prices peaking, and lumber prices have been in a downtrend since then, which says that for the rest of this year, housing-related stocks are going to be in a downtrend also, as they echo the move that already happened in lumber.
Chuck, is it possible that the housing stocks have simply gotten ahead of themselves?
It's possible they've gotten a little ahead of themselves because they've moved up so much in a short period of time. But if you look at the earnings capability of these companies, we think the upside is enormous. One that we own is Trex. The company is operating at under 30% of capacity. As more decking is used, the earnings are just going to explode.
Larry, you buy any of this? Do you like the housing sector right now?
Well, it's obviously a very good long-term value. The biggest thing as an investor to watch, if you're watching the sector, is the activity in the securitization market. Once they fix the reps and warranties on a lot of these mortgage products, once we can start issuing mortgages again to investors, then you'll get a big an absolute afterburner phase in housing. But until then, you're gonna ebb and flow and backtrack as we have been.
Well, Larry, you see a lot of flow across your desk over at Newedge. Are you seeing the buyers come in and actually buy that securitized paper yet?
I think the securitized market is much more healthy in the CLO market and corporate paper. It's all about the reps and warranties, which are the actual kind of the indentures, the prospectuses, the real language that's in the documents. People really lost trust with the mortgage market after 2008, and until they fix that, until they fix that process, that's going to be a little bit slow. But once it comes back, you're going to have a really nice burst in housing.
All right, we shall see. But it's interesting that none of you really buy the report out of the New York Fed. I kind of like that idea of 6% unemployment by 2013, but no one else seems to.
Well, we all like it. It's just a
happen.
question of reality, right?